I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His website's PIFinancial.com and PolarFuturesGroup.com. Best of the season, Drew, and welcome back to the show.
Thanks for having me on, Jim.
The U.S. Fed, as expected, pulled the trigger and hiked interest rates again, but of course the future is kind of a little squigglier, a little dimmer, or a little fuzzier than it was. What's your take on the hike?
Yeah, I was expecting the hike today as the market was. We were at about 70% probability that we were going to get a rate hike as we went into the release today. I think where the market got it wrong was they were looking for the Fed to really slow down their language for 2019. And one of the ways that we see their forecast for the future is what we call the dot plot, so where each Fed member sees interest rates going forward. The market has really moved to price in one interest rate increase through 2019, where the Fed new forecast that we got today had been at 3 through 2019. They did reduce it a little. We did come back down to 2 in 2019, but still a little firmer than the market was expecting. And the big thing today was we knew we were going to get the rate hike. We knew there would be some change in the dot plot, but when it came to the Q&A session where Powell was speaking, he sounded more upbeat on the economy. You know, they were taking into account some of the things like the trade tensions going on, some of the issues that the European Union was having with the Italian budget, but at the same time, you know, sticking to me, what their mandate is, which is full employment and price stability, or inflation as we know it. So with both of those measures right around where they want them to be, it seemed to make sense that they were raising rates today. Like I say, the market had been heavily leaning the other way, especially as we went into the release, which is why we saw such dramatic moves across markets when the interest rate announcement came out.
With higher interest rates, does that encourage people to save more and spend a little less?
Well, it's nice to be able to get something if you're going to leave money in the bank, and we're finally starting to see that. So, you know, if you are getting some payback for that, it may entice you to take less risk with your capital, because before, in order to get anything, you had to, you know, put it in a riskier asset to get any sort of return. So there could be, you know, not net just I'm either going to be invested or I'm going to be in cash savings and GICs, that sort of thing. But I think, you know, a sliding scale of, you know, where my overall risk is, and as you get paid more at the zero risk end of that scale, you're maybe a little more willing to slide down from the higher risk side of things to the lower risk side of things. And in doing that, you may be pulling more money out of equities, out of more, you know, riskier equities, more small cap equities, more momentum equities, that sort of thing. So I think that's partially what we're seeing with the sentiment change that we're seeing in the equity market.
Well, there must be concerns about the Canadian economy. The national news last night pointing out the TSX is back or below where it was at the start of the year, other indexes as well. And they're saying, how can you prepare yourself if we go into recession? So there seems to be some kind of view that no matter what the markets do, maybe the economy, especially in Canada, which is less robust than the U.S.
Yeah, I mean, Canada, again, we had the Bank of Canada at their last statement reintroduce the term oil shock. We hadn't heard that since the 2015 giant slide in oil prices. But again, we had oil prices at the beginning of October up around $76, hitting under $46 yesterday. So, you know, definitely a big and a fast slide in oil prices, again, isn't a good thing for the Canadian economy. Obviously, Rachel Notley in Alberta cutting production there to try and help domestic prices, which were even worse than the WTI prices that you see on the news all the time. So that alone is a big driver. But then, Canada has grown to have a very large real estate sector as well. As interest rates start to rise, that is a natural dampener on things like, or interest rate sensitive things such as real estate and even auto loans, that sort of thing. Interest rates going up make those loans more expensive, whether that's a mortgage or an auto loan. So Canada, slowing, and I think that makes sense. Given that interest rates are moving higher, do I think, we're in a lot of trouble? Not necessarily. But yeah, our equity index for sure has been, definitely very weak, especially if you compare it to the U.S. indices that are also now negative for the year and closing at 14-month lows or maybe even lower after today. But again, some of the underlying sort of Main Street economic numbers versus Wall Street numbers, to me, still look decent.
Well, maybe, too, a little bit of a warning with Bombardier laying off 5,000 people, GM announcing they're closing their giant Autoplex in Oshawa. Are those preliminary shockwaves or one-offs?
I think those may be a little bit more specific and call them one-offs if that works. There definitely are industries that are hurting, and especially if you look at share prices. The entire energy sector is, bottom of the barrel right now, and that hurts the company and, funds that they're able to raise and the number of employees they're allowed to have. And then you do have things like trade tensions that, hurt more global companies. That'll be GM and Bombardier, that, really do ripple through right into the jobs at home. You might not see it right away, but if you get fewer orders from international countries for bigger infrastructure projects, in Bombardier's case, or airplanes, you're going to see that slowdown come back to where the product is made. So I think we are seeing a little bit of a slowdown. Everybody's been saying the United States is a standout, island of, having done so well, and that finally it's playing catch up to the downside. And that maybe it's gross outperformance that we've really seen since May in U.S. equities especially, and maybe even general market could wear off a little bit. But again, I have to come back to the firmer economic numbers that you see coming in, to me, still say, Main Street's doing okay, and, we may have, some of these bigger global companies that, may get caught a little bit more than others in a trade war, have some more one-off adjustments to be made.
True. Places like Bombardier, every time they do a bad business deal and they lose money, the Canadian and Quebec governments bail them out. Is it time that the executives there should stop pulling in bonuses and pay the price for maybe not making the best business decisions? I could see with the C-Series jet that was taken over by Airbus, which is the 220 now, they'd insisted on developing their own engines when there were perfectly good engines on the shelf they could have purchased.
Well, that's a very political debate, more than one for me of trying to decide which way the market's going to take that information. I am more in line with, free markets, allow the market to decide where products are priced and which products get made and which companies make them, and can make them efficiently, effectively, and can turn a profit in doing so. So any subsidy, to me, it goes against what I believe, but at the same time, there are circumstances or special industries, again, national security sort of things, where does Canada want to get into a position where, we just dig things out of the ground or, chop down trees and send out raw product and don't have any, added benefit to us in Canada. So there's always that political fight. And as we see right now with added tariffs and trade tensions going on, that's, really hitting home with a lot of people. How much protectionism do you want to have for your own industry? Or how much do you want to be a free global player even if that means, like I say, you just dig things out of the ground and ship it out of your country. That's not a lot of value add for your country or for your citizens. So it is a balancing act, and I think you have to realize that which companies especially are caught in that balancing act more than others. You have some companies that are much more local and some that are much more international and at risk of being caught up in trade tariffs and trade disputes.
We'll have more with Drew Zimmerman right after the break.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Drew Zimmerman. Drew, the U.S. stock markets officially are in correction territory, down 10% or more. Do you see more drops in the new year?
I'm a little undecided on that. I think we're at a very critical point right now. The S&P index is right around 25,000. That was the low mark that we briefly traded down to when we had the volatility crisis at the start of this year. So far, the market seems to be holding that level. We've tested it a couple of times, even today with the spike down on the Federal Reserve raising rates. It looks, we traded through it intraday, but again, looks to be staying around that level. Again, I come back to, yes, we've come down into correction territory. You'll have many economists say we're taking this move down in stocks because the economy is heading into a recession. Therefore, stock prices need to come lower because corporate profits will be less, people will be less prosperous, so on and so forth. I still think this was more of a correction than a full-blown recession. I think we can see that employment in the U.S. has been incredibly strong. Canada has been stable, except for our last employment number was huge, but we don't have to get into the StatsCan numbers in Canada. But overall, again, I think if you look at some of the forward-looking economic indicators, your PMIs, your ISMs, a lot of the data is still looking very strong. Maybe not at the peak strength that it's been at, but, small business confidence is still strong. I think Main Street is still in a good position. And I think this shakeout or this correction has been more of a Wall Street doing. I think it's been a lot of the big momentum names that have been coming off. So you see some of the big FANG names, Apple coming out of the $1 trillion valuation to maybe more reasonable levels. So I think there's still, good profits that are getting made at a lot of these companies, and that, the Main Street economic numbers are still strong enough that people may start to have that shift in sentiment to say, we can pick up some good buys here. A company with a good dividend yield that has good cash flows to maintain that dividend at this level makes a lot of sense for me. So I think that's where you'll start to see some of the value investors that have, sorely underperformed the momentum names or the momentum investors over the last couple of years look to do a little better than they have over the past few years. So I think there's some value coming into the market at this level. I don't see an immediate recession that we're going to be coming into. I think, equities can do better as we go into the end of the year, into the start of next year. I think the Fed, may still hike again in either the first quarter or second quarter next year, and likely again later. And then we start getting into, how far have we gone with rate hikes that, and again, it's my view that we get most of our recessions from a Fed that's overhiked. So if the Fed is overhiked, I think that's yet to come. I don't think they've moved there yet. So I think overall equities, if you have some good value names, especially in the energy sector right now, I think equities could do better as we go into next year.
We'll have more with Drew Zimmerman right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, oil prices had stabilized above $50 for this week. We saw a lot of oil drops, with oil trading under $46. Western Canadian Select has come up in value quite a bit since Rachel Notley said they would cut their production by nearly 9%, a cut that hasn't happened yet. What will cause another round of selling? We also have OPEC saying they've talked to Russia and they plan to cut back even more if that will bring prices up.
Yeah, so we had the OPEC meeting and Alberta cuts, roughly in the same area, and we saw that stabilize crude prices. We had roughly 3 weeks where crude came down to the $50 mark or just below it, and then seemed to go sideways and consolidate. Look like it might be sort of, the safer place, the safer low for crude oil to be. But in the last few days, we've seen a couple of sharp down days where crude oil has traded under $46 a barrel, coming back up a little bit again today, above that. So, again, I think it is the market really trying to figure out where we are at with supply and demand. And the supply side has been, okay, we got production cuts, but they from OPEC that don't come into effect until January. We got Alberta production cuts that also don't come into effect until January. So we have a little bit of time. I mean, that is only a few weeks away, but a little bit of time until we get there. We also had a bigger discovery in the United States, where one of the big oil fields there has basically proven to have twice the recoverable oil that we thought it had before. And with the U.S. being the world's biggest oil producer now, the U.S. producing more oil gives us the idea that the U.S. can become energy independent and maybe very close to that. I mean, the infrastructure moves oil in exports and imports in different ways, but overall, if it was a closed circuit, the U.S. could be close to energy independence. But the bigger thing I think that we've seen since the turn of October with equity markets coming off is where will global demand be? And I think it's that maybe overreaction of markets saying, okay, this equity slide off, our trade tensions going on, maybe some of the slowing in Europe with the Italian situation, the Brexit situation that's still unresolved, a rise up in protests in France, that, maybe this synchronized global growth that we thought we had a year ago isn't going to give us the same demand as we go into 2019. I think that may be getting overdone and was what caused some of this sharp sell-off. There was also talk that right into the close, when crude dropped $1 in less than 15 minutes, it was a liquidation of some sort of oil fund as well that had to close out positions before the close of the day. So that's when you see these sort of capitulation moves in prices that are often overdone, and you can see prices come back from those levels. So I'll be looking for crude oil to come back towards the $50 level. Again, I don't think we have to see it rise aggressively. I think it can consolidate some more in and around this area, but I still think oil does better as we go into the new year and sort of steadies at this mid-40 up into the mid-50 level.
If oil prices do go a bit higher, do you think the Canadian dollar will follow those higher prices?
Yeah, Canada has been very correlated to crude oil, both, now and throughout the past and over the broad sweeps of time. I think there could be a little bit more pressure on Canada still going forward. I'm expecting the U.S. dollar could continue to do quite well, especially given the fact that the Fed has been, tightened rates today and still looks to be on a tightening path that's much faster than anywhere else in the world. That really moves interest rate differentials in the favor of the U.S. dollar. So if the U.S. dollar is going up, even if oil is going up, that makes it harder for Canada to do better. Our 2-year interest rate differential is, hugely in the U.S. dollar's favor as well right now. We got inflation this morning in Canada that was a little softer than expected. So I really think that given the oil price issue, some of our slowing economic data in Canada, and if inflation stays down, the Bank of Canada will be much happier to be in a wait-and-see mode. That is their data-dependent speech that they like to use. So I think Bank Canada is on hold as we go into the beginning of 2019. I think that keeps Canada lower as interest rate differentials work in the U.S. dollar's favor, even if we are getting a little bit of help on the crude side.
What's the U.S. dollar going to do, and how does that affect your outlook for gold?
Yeah, the gold market has been very interesting. It's really looked like it's tried to break higher. I've been watching it closely. Some of these recent breaks where we've traded up to, 1260 even, trading today. It was never confirmed to me by the silver market. It's also traded somewhat in line with copper prices over the last little while. Copper prices a little better today, but broke hard yesterday. So my thought is gold still in this consolidation range that we've been in really since summer. It's at the high end of what I think that range is. I think we could fall back towards the lower end of that range. I would look for either the 1220 or 1200 level to be support for gold if we do see it move back lower. And that's based on, as I said before, I think the U.S. dollar does better as the Fed is the only central bank out there looking to continue to raise interest rates and tighten monetary policy. And then by doing that, we're also seeing nominal rates, which had been moving lower. So the U.S. 10-year coming off 3.25 down to, I think we've got to 2.85. If the 10-year starts to head a little higher again, thinking the Fed is going to keep raising rates, you have the real rate of interest moving higher as well, which also is a pressure for gold. Gold moves in a negative correlation with real rates. So I'm seeing two of my big components on what drives gold, the real rates and the U.S. dollar, be a headwind for gold as we head into the end of this year and the start of next year.
What's been the story for junior gold miners, and what will be the story in the new year? Without having a specific company in mind, I mean, prices are always very important, but depends how junior. If you're an explorer, then you just need to find gold. If you are a producer, I think it is all about where your costs are at to get the gold out of the ground. But of course, gold prices will always be the biggest dictator of where there is interest in the market. So right now, it's been an incredibly tough market for any of the juniors to raise any kind of money because there isn't that investor interest in the space. So I think you need to see a stronger bull market move in gold, where then the interest will come back in. Once the interest is there, some of that riskier capital will go more into the junior miner space. But like I say, it takes investor interest for that to happen, and we're just not seeing that right now. People want to either put their capital in safer places or have deployed it in other riskier assets. Drew, thank you so much, and again, best of the season for you and your family.
Yes, Merry Christmas and Happy New Year to you and yours as well, Jim.
My guest has been Drew Zimmerman, Portfolio Manager at PI Financial in Vancouver. His websites, pifinancial.com and polarfuturesgroup.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. Questions for Drew or any of our other guests can be sent to info@HowStreet.com. I'm Jim Goddard. Best of the season.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.